So how do you calculate the intrinsic value of a particular company? That's what we're going to cover in this video. So guys, as you smash that like button, let me run that intro. What's up guys, and welcome back to the channel. Now I got a very interesting question from you guys, which I'll cover in this Q&A sub-series of the channel. And the question is, how do you calculate the intrinsic value of a company? And so that's what we're going to cover today in the Q&A series. And so the first thing I want to point out is that there's actually multiple ways to essentially calculate the value of a company. And you can see that here. There's a couple of methods. The most commonly used method, and I think that the most accurate method would probably be the discounted cash flow analysis. And that's the one that I'm going to walk you through on how I do it. But effectively, it's just what I highlighted here. It's projecting the company's future cash flows that are expected to flow back to the owners, and then discounting them back to the present value using a discount rate. And so the one point I think where a lot of people get tripped up when it comes to discounted cash flow analysis is you kind of have to think of it from the perspective of owners' earnings. So look, a business will make a lot of cash flow, but how much of that cash flow is actually going to go back to the owner? For example, if the business absolutely needs to reinvest all of the money it makes every year just to remain competitive, and it doesn't generate sort of like an alpha return on that because it always continues to have to put its chips essentially back on the table, then how much owner's earnings, how much cash is the owner really generating? So, on the income statement, you're going to show higher and higher EPS every year. On your cash flow statement, you're going to show higher and higher cash flows, but you're not really going to show higher and higher free cash flows because your cash flow for operating activities will effectively be the same number as your capital expenditures, and so your free cash flow is effectively zero. So this is why actually a lot of people like using the free cash flow methodology as it relates to valuing companies. The only caution that I would throw to the wind when you use free cash flow investing is sometimes you might calculate free cash flow lower than what it needs to be because you are not able to separate out the maintenance capex from the growth capex. And so when you're calculating free cash flow, you need to strip out that growth capex amount. And so this is why in my models that you see on the tracker, I generally will value them both ways. And then if there's a large difference between the two valuations, I really think long and hard about what makes sense. Sometimes I'll average the valuations out. Sometimes I'll just go with one or the other, and I'll note why. And so let's go back to this chart here. So that's the discounted cash flow analysis, and we'll continue walking through that. Now, the other one is the dividend discount model. Now, I would think that, or let me start with what it is. So the dividend discount model is estimating the value of the company based on the present value of its future dividends. So effectively what you're doing is all the dividends that you expect the company to pay out, you're discounting them at a present value. The only problem that I have with the dividend discount model is that not every company pays all of their cash flows out in dividends. Some companies do sort of like a 50-50 split where they'll pay out in dividends and then they'll also buy back shares, et cetera, et cetera. And so, the other thing is, some companies are currently reinvesting a lot of that capital and growing the business out, and they're not ready to stop reinvesting that capital. In fact, it would almost be seen as a little bit like criminal if a business has reinvestment opportunities, but they decide to buy back shares or pay dividends. You know what I mean? I don't think it's the right use of the shareholders' assets. Yes, the capital is being returned to you. However, it's being done inappropriately because the business has areas to invest in where it can generate a higher return. And so this is why I don't really prefer the dividend discount methodology as it comes to, or as it relates to valuing companies. But the dividend discount model is the best way to sort of teach a beginner how to sort of value a company. And so that for that perspective, it's a good place to start learning if you're just trying to learn. Now, the next three are just ratios. So the price to earnings ratio is just essentially dividing the company's stock price by its earnings per share. The problem, and then you just compare it with the average PE ratio of similar companies. The problem with price to earnings ratios is that, really there are some companies that are comparables, but no two companies are really alike. Companies have different debt profiles, et cetera, et cetera. And so, it's a good entry analysis point. I'll look at price to earnings ratios to determine if I want to research the company more, but I won't value the company exclusively on price to earnings ratios. And so, but I will use a PE ratio as a terminal multiple, so in a lot of my models, you'll see a terminal multiple from anywhere ranging from around 10 times earnings to 20 times earnings, depending on the type of company. The next one, price to books, it's the same thing. You just take the company's stock price or market cap and divide it by its book value. And so, this one is generally used to value banks, insurance companies, etc. Price to book makes more sense if you have a good idea of what the return on equity, essentially the return on the book over the long term could be. So for example, if you have a company and you know that they're going to generate a 30% return on equity, well, you can sort of de facto forecast that out and provide a multiple, put a multiple on the company. So it might require 2.5 times multiple if it generates that high of a return sustainably over the long term. You guys can agree to disagree. Let me know what you think about both the PE and the price to book. And then the price to sales. This is generally used for new companies that aren't really generating income right now. It involves dividing the company's stock price by the revenue per share. So it's a good metric for up and coming, fast growing companies. But even with companies that generally people use price to sales, what I will do, and you saw me do for the open door model, is I will forecast out net income into the future. And hey, if I have negative net income for the next 5 or 10 years before I achieve profitability with the model, that's just how I model it. I'm not a big fan of price to sales. So these are 5 very common approaches. There's other approaches. People customize these approaches to make it work best for them. And so this is a good start. And so ultimately, the point that I'm making is that the intrinsic value of a company is very subjective. And so let's go into sort of how I value companies. And so in order to walk you guys through this, what I did was I actually went into the tracker and I pulled up my alphabet model, because the alphabet model is really good as a use case for an example to show you how I value out companies. And so, as it relates to alphabet, or some of you guys just call it Google, step 1, I believe, is you really, really have to learn the business segments or the business and the segments, and take a position on how to forecast them out. So for example, the economics of Google search are going to be way different than the economics of Google Cloud, right? And then of course that'll be different from the economics of YouTube, the network member properties. There's a lot of people who don't even know what Google network member properties is. And if you don't even know what this is, then you might not really understand how this particular segment is in the eye of the regulators, and it's been for a long time. So you got to understand that kind of stuff. And then the other bet segment as well. And so every company has, or many companies have, multiple segments that you sort of have to forecast out. And so they have an overall segment which they call advertising, and the overall segment that they call services, and then within that overall segment they have sub segments. And so I just take a position on, or step 1, I understand what these businesses are. I modeled them out for the last 10 years. There's no quick and fast way of doing this. I do this manually. Like, I'll pull in some numbers from QuickFS, but largely this is all manually done. And I am very passionate about modeling companies, and so this is a lot of fun for me. But I know some people it's not so fun, but unfortunately I've never found a way to sort of like automate modeling companies the way that I like to model them, because every company is different. And so I'm sorry, I know a lot of you guys do ask for shortcuts on how to model companies. I just don't know one, but I also don't want one. The other thing is when I figure out how the segments operate, you can see here that in the red I have a percentage of overall revenue. So you can see that Google search is around 60% of the overall revenues, and you can see that cloud is around 7.5% of the overall revenues. Depending on the growth profile, because in purple you can see how it grew out year over year. So depending on the growth profile and its meaningfulness to the business, I'll forecast out sort of like how I believe that it should grow out, or how I believe it's expected to grow out. Now here's where the 10Ks, the conference calls, the press releases, and the company presentations really help you, because you're going to dig into those disclosures provided by management, and they will give you a good idea of how to forecast these segments out. And so you can see, I forecasted out 10%. For YouTube ads, I forecasted out 0 growth in 2022, and then 10% thereafter, and 15 thereafter actually, and so on and so forth. And as of the recording of this video, the reason why I forecasted YouTube out at 0% growth is because there's an advertising rate slowdown right now that YouTube has been experiencing, and so I've slowed this down. But by the time you watch this video, it might not be the case anymore, but that's okay, right? There might be other issues in the business overall, and so we take all that into account. And this is a living, breathing thing, this model. Like, it changes, I would say, every year. It may not change materially every quarter, but it changes every year with respect to how I forecast out revenues. And so you can see the overall, the fact that revenue grew up 41% in 2021, if you were to just look at the revenue growth rates and say, look, revenue grew up 41%, I'll grow it at 20% to be conservative in 2022. Well, you grew revenue at a rate twice the rate that it probably should grow out at, because if we go through every segment, we forecast it out based on the rate at which management is guiding us towards, or, based on the rate that sort of like logic dictates, you're looking at a revenue growth rate in around the low double digits. So 10%, 11%, that's it. I don't think you get this 41%. Now, can they outperform? Absolutely. But is it your job to forecast out significant outperformance in a model where you're trying to be conservative? No, that's how you get into trouble, right? And so I tend to be very conservative as I forecast these things out. And it's not just on top line. I also am conservative when it comes to forecasting out the bottom line as well. And what do I mean by that? Well, that takes us into step 2. So step 2 is where I take a position on the overall profitability of the business. Now, the reason why I chose to use the Alphabet model is because Alphabet actually makes this step easier, as they provide enough information to forecast the profitability of each segment. So this is really good. Now, sometimes, in most models, you'll see me actually forecast profitability by just going down the income statement, and that's fine as well. You'll see that a lot. But if the company provides us with the ability to forecast out profitability on a segment level, I'll always use that, as opposed to a more generic valuation where I'm going down the P&L. Now, Alibaba is another example where they give us the ability to forecast out profitability on a segment level, and so I really appreciate that. And I'll provide you guys with the opportunity for a link at the end of this video to get to the Alibaba model. But notice here that the Google services segment, in 2021 they had almost 40% profitability. I'm bringing that down because I believe that it's probably not going to be as profitable. The one area of interest is Google Cloud, and I'm just walking you guys through some analysis that I've done here just to explain to you how I think about this. But like with Google Cloud, one of the challenges with it is that it's not profitable, and the question people have is, when is it going to be profitable? Well, with this red number here, it just shows you the profitability, and so it obviously is a negative number, which means that it's not profitable. I forecast that it becomes profitable in 2024. And I put the note here that Google Cloud will be profitable very soon, but this is a risk, right? I wouldn't encourage you to be too conservative, but I do encourage you to be conservative. And so I think this is reasonable. I think it's middle of the ground. Some people might argue that the 30% profitability in 2026 might be too high. I would agree, probably, but I see it happening. So let's see how that plays out. And so you can see that, profitability was almost 31% in 2021, and notice how I don't actually get back to that level until 2025. So if you were to just forecast out the revenues, even if you just forecasted out the revenues conservatively, and then you throw on the same profitability level of 2021, you might have over forecasted net income for these years. And so you can see that the story with Alphabet is that profitability is still expected to increase. However, 2021 was just a high watermark year, and I don't expect that to occur in 2022. And so, profitability increases as cloud builds out, but profitability will not get to the 2021 levels until 2025. That's kind of the way that I'm thinking about this. And then, of course, I forecast out the tax rates. They just had they probably guided for a higher tax rate in 2022. I can't remember. Normally, I have a note here. And I might have just blocked it, but then of course thereafter I'm using 21%. But generally the CFO will tell you how to forecast out tax, and so this might actually have been a mistake. mistake. So I'll check this out at the end of this video. But if it's 29.1%, someone guided to that. That's just a random number to be in there. 21 and a half seems like more of an appropriate number for tax. Obviously they went under in 2021, but that doesn't necessarily mean that the tax rate will be that low in future periods. And so an interesting thing to figure out the tax rate is always listen to the conference calls. They'll generally guide you to the tax number in the conference calls, and if they don't, the analysts typically ask, and so in one of the analyst Q&As you'll probably get the tax rate to forecast out. This is very material for your valuation, so it's very important to get the tax rate number correct. Now, all that was done to calculate an EPS per share figure, which I have up above here in the model. And then what happens is I do something interesting that a lot of people always ask questions on, and it's not right, it's not wrong, it's just how I do it, and you guys can agree to disagree, whatever. But what I do is I have a medium term discount rate, which you can see here. This is that 5%. And then I have a terminal discount rate, which is this 11.5%. And effectively what's happening is the reason why I use a medium term discount rate is what a lot of people will do is they'll forecast out the medium term years like you just saw me do, profitability, income, all that, or revenue, all that stuff. But then they'll apply a really high discount rate to it. And the problem is you're double discounting risk if you do that, because you either forecast out risk in the P&Ls themselves, or you forecast out the risk using the discount rate. And obviously the I would say the correct method, in my opinion, and this is just my opinion, you guys once again can agree to disagree, is I forecast out the risk by being conservative in the P&Ls, and then the only thing I want the discount rate to reflect is a proxy for inflation. And so that doesn't mean that I'm expecting inflation to be 5%. Inflation could run much higher. I think in 2022 inflation ran maybe around 7%. I don't actually know. 2023, who knows if it's expected to run at 5%. It might be higher, might be lower, who knows. But I think 5% overall is a good proxy for the inflation rate, and the risk is addressed in the individual P&L valuation. Now, with respect to the terminal value, there's a lot of risk that we may not be able to foresee. And so what I do is I add a risk premium to my discount rate. I do not believe that the inflation rate will be 5%, or higher than 5% into the future. However, there are unforeseen risks that could occur, and so that's why I use a terminal discount rate. So you can see that instead of dividing the terminal EPS number at 1.28, which is just 1.05 exponent 5, which gets you the 1.28. That's just the formula to get it. I do 1.11.5 exponent 5, which gets me the 1.72. And so I take that terminal EPS number divided by the 1.72, and then I actually multiply it by the terminal multiple. This is just a shortcut that I use. You can actually build out the model for 100 years and you'll get to something similar, but you can just tack on a terminal multiple at the end, and then it just gets you to a subtotal amount, which is just the sum of these individual years plus the terminal value. And then of course to that I add any sort of excess cash and marketable securities. And what I typically will do is if the company has debt, I actually penalize them for the debt in the valuation. Now that's a controversial way of doing it because the debt isn't actually expected in many cases to be paid back right away, and so you could the correct way is really just to discount that debt. But the reason why I will penalize them for the debt right away is that if I were to use my cash to buy the business as a whole, the first thing I'd do is try to get rid of all the debt. And so to me, the value is lower than what it would be to other people. And so that's, just another, I would say somewhat controversial take, but it allows me to be a little bit more conservative. And so you can see I add these two together, I get a valuation of around 130. I compare that to the current share price. This is a pretty reasonable current share price relative to the valuation for Alphabet as of the recording of this video. And so when I'm done building my valuation, what I typically do is I put it onto my tracker. And you can see 68.2. This is probably the Google or Alphabet valuation. But what ends up happening is I just list them all with a share price, current share price, as a percentage of its intrinsic value. And then I personally just use this to determine what stocks I'm interested in looking further into and seeing if it's something that I want to invest in. I wouldn't just use the share price as a percentage of intrinsic value as a as a determinant to decide if you want to invest in that particular security. I think, what's suitable for you, always talk to an investment advisor. This is not something to use to determine what to buy and sell in terms of your investments. It's just an idea of like what I think certain companies are worth. So it's really just my brain, I guess, just tracking how I look at companies. And I unhighlighted Alibaba because it's very similar. It's trading relatively cheap to its intrinsic value. And if you click into here on the tracker, you can actually get into this Alibaba model, which is very similar to that Alphabet model that I just showed you. And if you want access to this, which includes the tracker and all of the models, you can get access to all of my personal research at this lower tier of the Patreon. I think this is the most value on YouTube, or the most valuable offering on YouTube, I think. And if you want to join us for an epic live call every month where, I go over my thoughts on the macro, I go over on how the certain securities have performed, I go over sort of like what I'm looking at, you can join us on this higher tier. Now, I'm really loving the fact that a lot of you guys are enjoying the Q&A series, and so I'm going to keep this going. And so if you've missed any of the videos on the Q&A series, you can actually get access to the whole series right here.